I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, an economist that takes all those statistics out there and boils them down to give us real numbers, a real picture of what's going on, not a bunch of fabricated junk and lies that we're told that everything's wonderful and the economy's great. If you guessed, I'm talking about John Williams at shadowstats.com. You are correct. John Williams, thank you for joining us today on USA Watchdog.
Greg, thank you so much for having me.
Well, good to see you. And I got to tell you, your prediction back in 13 was, by 2014, we're going to start seeing the beginnings of hyperinflation. Everybody's telling me that they're seeing inflation. We all had 0.1% growth. You said, in 14, the economy is going to start rolling over. First quarter, 0.1%, the best they could make it look. And your prediction looks like it's coming true. One of your most recent articles says that we have a renewed broad economic downturn that's continuing. And you're saying that we never really came out. Tell us your assessment of the economy, where we are right now.
Well, we're turning down anew. The first quarter should revise into negative territory as reported. And I believe the second quarter will be reported negative as well. That'll all happen by July 30th when you have the annual revisions to the GDP. Reality, the economy is much weaker than that. Economic growth is overstated with the GDP because they understate inflation, which is used in deflating the number. I don't want to get too complex here, but generally when you adjust for inflation, if you use too low a rate of inflation, that overstates the economic growth. And that's what's been done with the GDP. It's why, as you look at the GDP growth, starting with the recession that began the end of 2007, it just plunged and then it rebounded, where in reality it was more of a plunge and stagnation. We've seen that in a number of areas. I'll contend that is economic reality, and that what we're seeing now is just where we've been fairly stagnant and bottom bouncing, or maybe a little bit higher, that we're turning down again. And the reason for this is the consumer is strapped, doesn't have the liquidity to fuel growth in consumption, income. The median household income, net of inflation, is as low as it was in 1967. The average guy's not staying ahead of inflation. In the past, this has been a problem now for decades. You were able to buy consumption from the future by borrowing more money, expanding your debt. Greenspan saw the problem with income. He encouraged the debt expansion. That all blew apart in 2007, 2008. The income problems have continued, but now you don't have the ability to borrow money the way you used to. And without that, the income problems remaining, there's no way that consumption can grow faster than the rate of inflation if income isn't. And as a result, again, consumption here, personal consumption, is more than 2/3 of the economy. There's no way you can have positive, sustainable economic growth in the U.S. economy without the consumer being healthy. Just not going to happen.
And you're saying that if you look at the government's numbers, the way they compute everything, you see this V, whatever. But if you look at your numbers and you say you strip away all the garbage, you see down, plunge, bottom bouncing, plunge, in all categories. It plunge, right. Bottom bouncing, and now you're saying plunge, bottom bouncing, and another plunge is coming. Is that what you're saying?
Yes. Exactly. That's what we're seeing now. And the first quarter, 0.1% growth, that's as low a positive number as the Bureau of Economic Analysis could come up with. They don't like to go, when you're plus a tenth, it could just as easily be minus a tenth. There's plus or minus 3 percentage points around this number, so that's not statistically different than a contraction. And that's quite something for the government to actually report it that low. It's going to revise lower. And what we've seen in April reporting suggests that the economy is continuing to sink. Retail sales adjusted for inflation were down. Industrial production was down. Inflation's rising. The more inflation rises, the more what looks like positive growth in retail sales turns negative after inflation adjustment. If inflation's growing faster than the retail sales are. And again, this is a problem with the consumer. Consumer's not keeping up with the with inflation. Consumption's not going to keep up with inflation, and the way that measure means consumption's going to be down, GDP's going to be down.
So you've been forecasting this for a while, that by the end of 2014, we'll see the beginning of hyperinflation. Well, we're seeing the beginning of inflation. All my viewers on my YouTube channel and on USAWatchdog.com are, you bring up inflation in the grocery store and boom, everybody agrees. I mean, I don't hear anybody say, oh, no, prices are about to, no, inflation. So let's do a little forecasting with your hyperinflationary, the beginning of it in 2014. So you've already said the economy was going to roll over. Check. You're saying the economy is going to continue to go negative in the second quarter. Check. What happens then? What's your forecast? What is the Fed likely going to do? Continue to taper the bond purchases or pour, gas on the fire?
I'll contend that the Fed's tapering is more political than anything else right now to make the new Fed chair look as good as possible. The reason for the quantitative easing was not to boost the economy. Very little the Fed can do to prop up the economy. The quantitative easing was aimed basically at providing liquidity to the banking system, keeping the banking system solvent. Talked about the weak economy, that's political cover for the Fed. And we've got a weak enough economy now, and Fed Chair Yellen's talking about boy, the economy doesn't look like it's in recovery. It sounds to me like that's political cover for cutting back the tapering and moving towards new easing. That in turn would trigger some selling pressure against the dollar. The government's not bringing the deficit under control as they're advertising, using generally accepted accounting principles, as the Treasury does report it, but not heavily publicized. You're not seeing a deficit of $400 or $500 billion. You're seeing something close to $6 trillion. That's beyond control. It raises a question of the long-term solvency of the U.S. That's a big concern for the global markets. It's one reason that nobody outside the United States really wants to hold dollars. You look at the U.S. economy. The economy is turning down. Economic strength, relative economic strength, is a big factor in the trends. As the renewed downturn, gains wider acceptance here, wider recognition, that will intensify the selling pressure. Political instabilities. Right now you're seeing a government that's having problems functioning the way it would on a happy basis in the United States. A lot of bickering, not too many positive things being done. President's popularity is down. Whenever that happens, and it happens fairly frequently with presidents, that's usually a good selling sign for the dollar. All these factors, you have a confluence of factors. You have the global political risks, and people such as China and Russia and Iran making noises about dumping the dollar, getting the dollar removed as the world reserve currency. We have many friendly powers that are in a similar circumstance. They know the dollar's going to lose its value. It's not worth what it's priced at now, but they don't want to be the guys that trigger the dollar sell-off. On the other hand, when someone starts selling, it's going to be a race for the door. And I'm looking for a dollar selling panic to be the proximal trigger for the onset of the hyperinflation. What we're seeing in the way of inflation now is a pickup in inflation, but it's not a hyperinflation. Massive dollar selling, that'll be the trigger for the hyperinflation.
And then, just so people understand this, and I know this because you've said this, and I think it's an eye-popping statistic that you've come up with. You say there are at least 16 trillion with a T dollars and liquid dollar assets held outside the country. And when you start hearing that, Russia and China want to de-dollarize the world, and we have all this political instability, and then we have China over in the South China Sea, and we're upset about that. And we have us at loggerheads with Russia and Ukraine, the Ukrainian crisis, and Russia saying they're going to, get back at us economically. You're saying that this is the trigger that, there could be, our friends might say, well, we're your friends, we like you, but we're not going to take a beating on these hundreds of billions, if not, a trillion or whatever they got in terms of dollar. You're saying everybody's going to try to run for the exit door at the same time. Nobody wants to hold the dollar. Is that what you're saying?
That's right, and indeed the dollar is going to as I see it, virtually go to zero in terms of its purchasing power. You don't want to have your assets in U.S. dollars.
That's an amazing statement. You think it'll virtually go to zero in terms of purchasing power of the U.S. dollar, and you're saying that's
what you would have with a hyperinflation. The simple example of when it gets very rapid and the pace is just beyond belief, the pace of inflation. Back in Germany in the great inflation they had in the 20s, you could buy an expensive bottle of wine at dinner one night, and the next morning that bottle would be worth more as scrap glass, empty, than it had been the night before filled with expensive wine. That's how rapid this can unfold, how rapidly this can unfold.
And, okay, so first quarter, just to recap, first quarter was a disaster. Second quarter is going to also be a worse disaster, negative. What do you suppose the government's going to start doing? What do you suppose the Fed, the government, what are we going to do? What's going to happen?
Well, all the projections on the budget deficit are based on positive economic growth going forward. You have an ongoing contraction. You'll see a much worse budget deficit. It's going to do bad things to the banking system. Again, all the recovery projections are based on positive economic growth. If you have contractions there, it puts more stress on the banking system. The Fed's going to be easing, and they'll say we're easing to stimulate the economy, but in reality, again, they're doing this to try and prop the banking system. The rest of the world sees this. They don't want to hold the dollars, and as they sell off the dollar, again, you have a confluence of factors playing together. The Fed's going to have to come in and continue to prop up the system until it falls apart.
There's no saving it with what they're doing, is what you're saying.
I don't see anything here that'll save it at this point.
And finally, I know you got clients both, like small-time investors. One of my friends advised your newsletter. He loves you. And you got big-time clients, too. What's the feedback you're getting from your clients? What are they thinking? What are they telling you?
Well, I have mixed responses. Some people see it coming, and they're taking actions to protect themselves so that they can preserve the purchasing power of their wealth and assets through the crisis, maintaining liquidity, getting assets into gold, silver, outside the U.S. dollar. Others aren't so sure, but they want to look at the risks and assess what's happening. I had a circumstance. I've actually only been assaulted once for my outlook here, and this is a very nice lady at a board of directors meeting for a bank up in New England. And she got up, the poor woman was in tears, and she said, "All you have is bad news." And she picked up a jelly donut and threw it at me, hit me right in the chest. A very good arm. And as she did that, the bank chairman stepped in and he says, the good news here is that you know what's going to happen. And if you know what's going to happen, you can protect yourself. You can take action to protect yourself. And that's what I'm hoping people will look at, is what do I need to protect myself? How do I, suppose Williams, this crazy guy, is right. What can I do to keep myself solvent, to protect myself and my family? And there you need a couple of things. The simplest, putting some assets and some cash into hard assets such as physical gold and silver. Getting assets outside the dollar where you can. But also because we'll see a disruption to the system here when the hyperinflation hits. The currency will be worthless. You probably break down the barter system, but there'll be a period of time where things are going to be in probably tremendous disorder. And it's like a natural disaster. You want to have a store of food, canned goods, diapers for the baby, whatever you need to get by for a couple of months. Same thing you do for a natural disaster, only here it's for a man-made disaster. Just get stuff that you can recycle. That's not too expensive. It's just basic common sense. And then if you're looking at it, you'll have some indication that before it gets really bad that it's coming. Get more and more of your assets more and more of your wealth and assets into stuff that will survive a dollar collapse.
Well, I do want to take exception to one thing. The crazy John Williams, you're an Ivy League trained economist. You've had plenty of big time and small time clients. Nobody thinks you're crazy. Not anybody on my channel thinks you're crazy. And these are just the numbers you take. This isn't your political bent. I know you're really. I don't even know if you're Republican or Democrat or Libertarian or whatever. I don't care. Don't tell me.
Well, I'm always.
This is just the numbers. This is what you see. You say, here are the numbers. Here's what I see.
I keep politics out of my forecast, but I'm always open about where I stand. I'm old-line conservative Republican with a libertarian bent, and but that has nothing to do with my forecast. I'm equally disgruntled with both of the major parties at this point in time, because they both of them have led us to where we are now with disaster, fiscal disaster, which is the root cause of everything else that's happened here. We borrowed so much from the future, there's no way of possibly paying it off. And that puts you into the hyperinflation.
You're saying the future is here today.
The future is here, yes. You had a former Fed chairman who had been tutored by an earlier Fed chairman, said, hey, look, you ever run into political problems? Two things that'll save you. Not a vote in either one of them. One is you let the dollar go to hell. And the second thing is you don't have to worry about the budget deficit. None of that will cost you any votes. And now we're to the point where the dollar has been ignored for years. The federal deficit's been ignored for years. But that's where we are right now. That's what we're on the brink of disaster with. The time has come. There's nothing forward in the future for this. We've got to get those things addressed now. And it just not happen.
John Williams, economist at shadowstats.com. John Williams, thank you so much for the sobering forecast and for coming on and warning people to take cover. Thank you, sir, for joining us today on USAWatchdog.com.
Again, Greg, thank you for having me.